Hi again, guys. Welcome to lesson 3 of 5 on depreciation. We're going to be looking at the third possible option for depreciating a non-current asset. This method is called the revaluation method. A little bit of theory before we start this one. This is the easy one, so you'll be glad to hear this. Reason why we have depreciation. Okay, big one is just sheer usage. So, for example, with a car, we are using the car all the time. Eventually, it's going to wear out. You've got depletion, for example, a gold mine. If we buy a gold mine, as we dig out some gold, we're going to, the value of our gold mine asset is going to decrease. Technological, so a lot of items just become out of date. For example, computers. If you try to use a computer that was purchased 10 years ago, that computer may still be functioning, but it wouldn't be able to use any of the modern software. And the final one is time. Probably more applicable to students watching this studying AS. Okay, things like leases are now considered to be assets. However, at the end of the lease, it's worth nothing to the company. A little bit of theory, if you're an IG student, it's nice to know rather than must know, but this is all covered under something called IAS 16, which is property, plant and equipment. In IAS 16, there are two methods allowed. One is called the cost method. Both reducing balance and straight line depreciation are examples of the cost method of depreciation or valuing your non-current assets. The revaluation method, which is what we're going to do now, is the second way that's allowed. The theory about why we do, both IG students and AS students need to know. The first one is we've got a concept called prudence. Prudence says we shouldn't overstate profits and assets or understate liabilities and losses. And there are two big elements to this linked to depreciation. The first is if we keep our non-current assets in at cost, for example, a motor vehicle which costs $20,000, we are clearly overstating the value of our non-current assets in our statement of financial position. And therefore, people using the accounts will have an inaccurate idea about how much the assets of the business are worth. Also, because we should have put in an expense for the decline in the value of our assets, our profits will be overstated. Linked to the second point is something called the matching, or you'll often see it called the accruals concept. And the accruals concept said that what we should do is we should match our expense of the business with the year in which we actually generated revenue. And we do know with most non-current assets that they are going to decline in value over time. And therefore, we should match that decline in value over the time as an expense with the years in which we receive revenue from it. So we should try to put in an expense of depreciation each year that reflects the amount of the asset that was used. Okay, really final bit of theory, probably overload here, but land is a funny one, and very often you'll see land doesn't get depreciated. Right, how do we use a revaluation method? It's very, very easy. Okay, it's used very often for small value items of non-current assets where we own a lot. So, for example, the restaurant, they might use it for crockery, i.e. pots, cups, bowls, plates. A builder might use it with small tools. Got a lot of them, okay, and they're just going to get a value placed on them at the end of the year. So Janet purchased some tools for $5,000 in year one when she started her business. That would get debited into a tools account exactly the same as we've done in the past. You credit the bank because we lose the bank asset, debit the tools because we gained a tool asset. Now what Janet's done is she's found out at the end of the year that her tools are now worth $4,500. So that becomes our balance carried forward in the tools account. What you'll notice this time, there is no depreciation account. Okay, so what we do, we look at the difference between the 5,000 and the 4,500, and that gives us $500 worth of depreciation needs to go into the books for year one. So the amount of the value of the assets brought forward is going to be $4,500. No depreciation account, but there will still be a corresponding debit entry in the income statement for tools depreciation. Okay, bought the same figures down. Okay, but in year 2, Janet's gone out and she's bought an extra $1,000 worth of tools. So we need to debit the tools account for $1,000. That gives us a total on the debit side now of $5,500. So we know that the credit side's got to be the same. We just balance off the normal way. And we know that the tools that she has are valued at $4,200 at the end of the year. So a balance carried forward now is going to be $4,200. A balance brought forward is going to be $4,200. And the depreciation then will just be the difference between those, between the amount carried forward and the total value of all the tools that she's purchased. Okay, so that's going to be 1,300. So just to summarise how we worked out the amount of depreciation, we had the opening carrying amount for our tools, we added on what we've purchased, $1,000, and we subtracted the amount of balance carried forward, okay, and that gave us 1,300 of depreciation. Okay, simple to do. I've got an example here where you're going to do them all in one account. Okay, don't forget to fill in the self-assessment at the end. Okay, but it's to do with Pedro, who started a restaurant. Good luck with that. Good luck in the lesson. Make sure you had your homework in on time, and you'll hear from me very shortly with lesson 4 and 5 on this topic, where we'll be looking at disposals.